We are kind of midway through the fourth quarter earnings season, and this is a good time as any to check whether the results season so far has been in line, better than expectation, or worse. We also need to know which stocks are better and whether a course correction is needed in terms of sectors and stocks that we need to pick. I have with me Gautam Duggad, the head of research at Motilal Oswal Financial Securities. His team has just completed a comprehensive mid-season review, so the right man to take us through the results season. Gautam, thank you very much indeed for joining us. Well, first up, what is the overall picture? In line or better?
Hi, Lata. Good morning. Thanks for having me. Yes, the picture is in line. Actually, when we put out the preview 3 weeks back, I had this marginal fear that maybe the numbers may miss the expectations, though it must be said that we are still halfway through the earnings season. About 100 companies in our coverage universe have posted the results, 130 more to go. And on Nifty, 28 companies have done. So roughly, in terms of the index weight, for Nifty, 75% of the index weight has posted the numbers. By and large, so far, the numbers have been in line. I mean, when I look at our aggregate estimates for this 96 companies, the earnings growth is about 8% versus expectation of 8%. And similarly for Nifty, it's about 8% versus similar expectations. Had it not been for that marginal miss in Coal India because of that higher wage provisions, maybe the numbers would have been slightly better. But Lata, the bigger problem is this results or corporate earnings are still being led by 2 or 3 sectors. You know, you still have financials driving it significantly. Without financials, there is actually an earnings decline of 3-4%, which, by the way, is still in line, but it's still a decline without financials. And then you have auto, which is doing exceedingly well after a long time, which we had also highlighted in our results review of the December quarter. So these are the 2 sectors which are driving. Rest of the sectors are still very uneven. I mean, you have consumer doing about 13-14% growth, tech at about 10% growth, and then global cyclicals like metals are dragging it. So I would wish that this breadth to the earnings get better in terms of sectors which are contributing, and it becomes far more broad-based going forward, because financials, after exceeding 5 years of a consecutive strong performance, will now start encountering a very high base. I mean, just to repeat a number which I always repeat in our interactions, the profitability of financials in Nifty, the 11 companies in financials that are part of the Nifty, has gone up from 45,000 crores to about 210,000 crores in a matter of 5 years from FY18 to 23. And from here on, the growth for FY24 can be a bit more normalized now. So therefore, it is important that corporate earnings get a bit more broad-based than what they actually are today.
Okay. Well, your reply is throwing up a lot of questions. I want to come to the financials bit, since it's of personal interest to me, the banking sector. But first, let me ask whether you are revising any of your FY24 numbers at all. What were you in terms of Nifty EPS before the earnings season started? Where are you now?
So, Lata, it's fair to say that numbers are stable. You know, we were at about 812 rupees for FY23. Right now, we are at about 815 rupees. For FY24, when we started the quarter, that is the preview, on 5th of April, we were at 978 rupees. Currently, we are at 976 rupees. So hardly any change in our EPS estimates for FY23 and 24. If this 850 number gets delivered for FY23, it will be a growth of about 13%, which, one would say is slightly lower than what we have seen for the last 2 years. But also remember that this 13% growth is coming on a very high base of 38% of last year. Second, this growth is coming despite all the global and domestic challenges on rates, overall macro slowdown globally and in domestic that we have seen. So I will take this 13% number, quite happily, because it's coming on a very high base, and it is continuing the trend of a double-digit growth which started in FY21 after a hiatus of 10 years. So FY21 was the first year of a double-digit growth of 20%. On that, we have grown 40% almost last year in FY22, and now we are growing 13%. The question mark is for next year, where our assumptions currently indicate about 18-19% growth, and kind of environment that we are living in. I'm sure that this number will see multiple round of changes, both on upside and downside as we move forward.
Oh, that was going to be my question. Do you fear more downside? Simply because, as you said, banks have already delivered a goodish bit. And secondly, there are global headwinds. So are there dangers to this fairly robust, 17-18% for FY24?
Yes, Lata, I do expect some cuts, but not material enough to question the growth story. So, for example, when we started FY23 itself, it's always, predictable that, next year people are always more rosy about their assumptions. So let us take a step back and look at how FY23 has panned out. In April 2022, when we first published the FY23 estimates, our EPS estimate for FY23 was 870 rupees. Today, as we speak 12 months later, we are at about 815 rupees. So roughly 6 to 7% of cut has happened. But this year, we have seen a lot of challenges. You have seen commodity rallying all the way up to $115, $20 kind of a crude. Then interest rates going up by 250 basis point has its own role to play in terms of earnings moderation. And of course, the equity valuations also, which saw some moderation because of the higher interest rate. I don't expect the commodities, while it is always difficult to predict commodity prices, but I don't expect such kind of an upheaval that we have seen in FY23. Similarly, rates, everyone agrees that you are the best person to judge that, whether we have peaked or not. But I think we should not see any significant increase from here on as far as rates are concerned. So while FY24, you can see some bit of a downside risk given some of the sectors which are globally linked, like metals, oil and gas, and IT. But I would still say that around 13-14% growth for next year also is in the realm of possibility, because you're seeing a sharp rebound in auto after 5 years. Second, in metals, which has seen an absolute depressed profitability in FY23, might see some recovery. And then you have sectors like consumer, IT, and pharma, which might do their usual 10-15% kind of a growth. And financials, even if it does 17-18%, we are on course for about 14-15% growth for FY24, if not 20%. Okay.
No, my only worry is, you said you did your first analysis in April 2022. At that time, you already know about the Ukraine war, and you already know that the Fed has pivoted, and the dot plot was indicating, 5% peak rates. So in spite of it, you had to bring it down by about 6 percentage points. So, we have to keep our options open for the current year.
Absolutely.
But what are your buys? Therefore, what would you buy? See, buying is not just performance, it's also what is priced in. At the moment, is it a no-no for IT? Or is the bad news in IT and therefore that's also in your buy list? What's your buy list?
So there are 3 or 4 sectors which are predominantly in our buy list, which are part of our model portfolio and also populate our top ideas. Number one, obviously, is financials, because the strength of the underlying earnings and fundamentals remain extremely robust. The asset quality is the best in the decade, still saying 13-14% credit growth. Yes, there can be some moderation in the net interest margins given the lagged repricing of liabilities. But I still think that given the derating that financials have seen in the last 3 years, the price value equation or risk reward is still favorable for financials. So we like both PSU banks and private banks and select NBFCs. Second sector where we have turned positive off late in April when we did our model portfolio was consumption. We've gone overweight on consumption after being neutral for a year and a half. And the reason being simple, that you're seeing some moderation in commodity prices, bottoming out of the demand trend, especially in rural. And third, the prices have time corrected over the last 2.5-3 years across most of the consumer spaces. So that is one sector we've gone sort of overweight. Third is auto, where we've changed our positioning back in January itself. And we are seeing the numbers again getting upgraded second quarter in a row after 15 to 16 consecutive quarters of a downgrade. So auto remains a big overweight for us right now. And lastly, IT. I agree there are a lot of challenges there, both on global front as well as the lack of visibility on some of the macro parameters. But I think valuations now factor a lot of things in. CY22, the worst performing index in Nifty was IT. It was down 27-28%. On top of that, this year also, first 4-5 months, we have seen a correction. For a company which generates or rather pays out 90% of cash flows and have 100% free cash flow conversion and available at about 20-24 times, I won't fret too much about some declining growth, given this very strong track record over the last 2 decades of wealth creation that the sector has offered, especially in the large cap IT. So that is one another space where we will place our bets on. So these are the four sectors: financial, consumption, IT, and auto.
The second half of earnings season usually is weaker than the first half. Any worries about whether you will have to downgrade a little more? And if yes, which sectors would you put on your watch list?
Yeah, Lata, you're right. I mean, the second part of the earnings season is always more notorious because more volatile companies and sectors, whether it's PSU, commodities, they sort of tend to populate the earnings in the last 5 or 6 days. I would reckon that given 75% of the index weight has already posted their numbers, right? The rest 25% of the index weight, which is going to post the earnings over the next 10-15 days, even if you assume a 4-5% earnings cut, you're still talking about a very stable sort of earning scenario as we speak. I think the real game for FY24 will begin post September 23, because that is when we will be in a better position to assess whether the overall economic growth is on the improving trajectory. Because right now, all said and done, 2H FY23, we are still living in a 4.5% GDP growth environment. Our own estimate for FY24 is about 5.2-5.3% on real basis and about 8-8.5% for nominal basis. So I think over the next 6 months, it will become more clearer. Right now, earnings picture will still look very stable, right? Plus, one should also appreciate the fact that macro and Nifty earnings are not 100% linearly correlated, because large part of the earnings also come outside of India.
Oh, yes. Of course, don't we know, last 2 years we have had GDP numbers in the negative, and corporate earnings were 38-40%. So quite clearly, we shouldn't read too much of GDP extrapolation. Gautam, we'll leave it at that. Out of time. Thank you very much indeed for joining us.